Hi there, and welcome to the OptionPit special webinar, Volatility and Earnings, the OptionPit method, using volatility to analyze earnings. So before we begin, why don't we talk about myself? My favorite subject, me. My name is Mark Sebastian. I'm the founder of OptionPit. OptionPit is an education and consulting company. We work with individuals and professionals to help them implement and test option strategies. We work with clients with as little as $1,500 or $2,000, all the way up to clients that have $15 billion. Really, we're willing to help anybody if they're the right type of client. All right, we do research and write-ups for the street, tell it pre-bond. We're kind of all over the place when it comes to the professional and institutional side, as well as the retail side. Now, in addition to that, I run a small fund called Carbon Line Capital that is primarily volatility arbitrage, trading in VIX and the S&P 500. All right, so with that, let me remind everybody that this presentation is for educational purposes only. And if you have, none of this should be considered as investment advice. Consult your financial professional. Options have risk. All right. So if you lose money, it's your fault. Basically, what I mean. So anyway, I was prior to being the founder of OptionPit, I was a floor trader for a decade on the Amex and the SIBO. So that's me. All right. So now, volatility can act like a headwind or tailwind to successful trading if you do it right. We're going to talk about some basic buy-sell decisions. We're going to look at the analysis of expected stock movement ahead of earnings. We're going to build some trades around earnings, and we're going to talk about earnings flies, as well as maybe a little tip of things you shouldn't do. And if we have time at the end, I'll actually look at an earnings trade or two if we have time. So has this happened to you? Mark. Market makers are cheaters. I bought all these calls right before earnings. The stock is way higher, but I'm not making any money. Market makers are taking my money. Whenever I give presentations on this stuff, at least once a week, at least once a month, somebody says something like this to me, and it's just not true. No one took your money. Something changed. All right, volatility changed. All right? And that's really the key. All right, one of the major inputs into what you were looking at changed. So now let's talk about volatility. There are three main types of volatility, and each one is useful. All right. The first is realized vol. Realized volatility is how much something is moving right now. All right, so how much is something moving right now? All right, it's the daily move, it's the immediate move, it's what's happened in the last day, week, hour. All right. While all moves end up being historical in nature, right? If I take a step forward, while my move was historical in nature, it's really what just happened. And that's really what realized vol represents. One decent measure I look at is 10-day historical volatility. So this is like a chart, an older chart of Google. You can see, here's how much Google is moving around. All right. That is, if I pull up my software, there's all sorts of stocks I can look at, and I can see how much they're moving around. All right, there's that 10-day vol. All right. So That is realized vol. Next, you get historical volatility. All right, historical volatility is how much things have moved in the past. It can be viewed in monthly increments or daily or, 20 days, 30 days, 60 days. Tends to be mean reverting. So if you look, here's 10, 20, and 60. And what do you notice? The further out I go, the more time I have to look at this stuff, the flatter it looks. So here is 1 year of historical volatility in Goldman. Here's the SPX, the S&P 500, if you will. All right. Now you're saying, wow, what a big move, until I put 20-day over it, and then you realize it's almost no move. Or 10-day. In 1 year, volatility went from 10 to about 15. All right, now, finally, there is implied volatility. Implied volatility measures how much the market is expecting the underlying to move based on the price of options, all right, and it is an output of a pricing model, all right. There are many indexes on this. You can use all sorts of different, or you can use live vol or metastock. In this case, I can show you live vol. That's what I've been using. Oop. So here is VXGS, and that is the VIX of Goldman Sachs. And yes, there is one. And this is a index that actually is put out by the SIBO to track vol and Goldman Sachs. And there are all kinds of indexes like this that you can follow. If you don't have a good vol analytics and you're a gold trader, here's GVZ. All right. If you're a NASDAQ trader, here's VXN. VXN, OVX for oil traders, VXAPL for Apple traders, I mean, there's all sorts of different, TY VIX for the 10-year note. I mean, there's just hundreds of these indexes. And if you don't, and then if you take it a step further and you get something like live vol that I use, I can look at a volatility on VXX. I can look at implied volatility. Or Tesla. Or Facebook. Now, what makes implied volatility so different than trading stocks? Well, Goldman can go anywhere and keep going and or stay there. You can just go and go and go. Whereas implied volatility can go anywhere. We've seen the VIX get up into the 50s and 60s. It eventually will mean revert. It will get back to its initial, it'll get back to its average. All right, the long-term average for the VIX is, around 17. So You know, that's how this stuff can move. Implied volatility has mean reverting characteristics. So like, let's take a look at Goldman. Does this look like it really has a mean? Take a look. No, not really. Now take a look at VXGS and you tell me. Look at how little that 200-day moving average actually moves. That's that gray line. So that's the thing to remember, is the stock price can go anywhere and stay there. Volatility can go somewhere, but it must revert over time. Understanding this will help you with buy-sell decisions. All right? When vol is low, you want to buy it. When vol is high, you want to sell it. All right? Now, the next step is strike selection. And this is done based on the certainty of the next volatility move. So when you believe implied volatility is going to drop, all right, you want softer deltas. Those are deltas that are sensitive to changes in implied volatility. When you believe that IV is going to be stable or go down and you're buying options, you want hard deltas. Those are deltas that are, you know, a little tougher. All right. So one believes that, so if you think vol might go down, you don't want to own soft out of the money options. Yeah. And when you think volatility could go up, that's when you want a soft delta. A soft delta is out of the money, and a hard delta is at the money or in the money. All right. So hard deltas are relatively resistant to change in volatility. Soft deltas are dependent on changes in volatility. So like, take a look at this chart of Apple. All right. And you look where the volatility is. All right. Apple's at this time is trading around 100. All right. Your hard delta is going to be the 102 puts. Your soft is going to be these out of the monies, these 80s. So look at that volatility. So there's the 26. Look at the volatility here. 84, 88. This 94 is the soft delta. This 102 is the hard. Now take a look at the drop. It dropped $6. See that? $6.50. Now take a look at this delta. On $6.50, how much value should my 94 puts gain that are trading 75 cents if they're down 6.50? Well, it's pretty simple, right? 6.5 times 0.2. They should gain at least $1.30. Meanwhile, my 102s that are 3.80 are 58. So they should gain 58 times 6.5, or $3.75. Well, let's take a look at what happens. Well, my 102s, which are now a 97 delta, actually pick up $5. So they did better. Meanwhile, My 94s only pick up 60 cents. So even though they were now in the money, and Apple absolutely tanked, my puts here didn't do that much for me. They weren't that great. In this case, because of this high implied volatility, 84, I wanted something a little harder. I wanted a harder delta. All right, does everyone understand the difference between owning a hard delta and owning a soft delta in terms of exposure? So while Apple moved beyond what the market was expecting from its move, the out-of-the-money put actually underperformed the in-the-money put. The key is that out-of-the-money options tend to get completely overbought into earnings. Straddles tend to be more fairly priced. Now, what is a straddle? All right, the straddle is how you're gonna analyze earnings. All right, a straddle is the value of an at-the-money call and an at-the-money put together. All right, so a straddle is the market's best guess at how much the underlying might move between now and expiration. It's about 80% of the standard deviation and is going to be right about 50. It's going to be about the right price or a little more about 58% of the time. It's rarely dead on, but over time, they are pretty accurate. All right, so the at-the-money straddle price of a weekly option is going to give you the best guess of what might happen. So let's take a look at a weekly straddle here. All right, these are the Jan 29s on Tuesday the 26th. And you can see the market was pricing in about a $5.90 move, $5.85. Right. And Apple moved a little more than that. All right, so it's pricing at about a $5.90 move. Knowing that can be valuable. So now the next step is to look at historical moves. So how much has Apple moved in the past? Having an understanding of how much Apple might move in the past is going to give you a better idea of how much things might move. So the first key, all right, Apple's predicting a 5.9% move. We never want to buy options if we're trading outside of this net straddle price. You don't buy cheapy, way out of the money options. You want to buy options that are inside this straddle price. So let's take a look at Tesla. All right, Tesla had earnings this, last night. You can see that, did move around a little bit. You can see it's typically moved a lot on earnings, right? It's gapped and then continue to move out of it, earnings. Lots of movement, right? Look at that earnings, and straight up, earnings here and down. So let's think about it. We just saw how soft deltas tend to underperform and hard deltas tend to do kind of what we expect or better. So if you want to play directionally on earnings, in earnings week or into earnings the next week, we want to use spreads as opposed to buying little cheapy out of the money options. So here's Tesla yesterday, right? See, the volatility was 43 bucks. All right. The market was looking for about a $14 move. A $14 move. Did Tesla move 14 bucks today, guys? No, it did not. Tesla moved about $4. All right, so if you had bought a August 225 or 227 call, even those harder deltas, you probably didn't make very much money. If you bought something more deeply in the money, you probably won, but you were putting on a lot of risk. If you bought out of the money options, you probably got lost. I mean, we'll take a look here. Take a look. All right, so I can buy a 225 call for, I could have bought a 225 call for $7.20. Or what if I bought a 225, 245 call spread for $6.40? Or I bought a 225, 240 call spread for $5. How did those perform? How did the two perform? All right, the 20, the 20-point vertical for $6. Sorry, that's a typo. Well, let's take a look. Well, here we are today, and my 225, 245 call spread about broke even. My 225 calls lost. My 225, 240 call spread, if I paid $5 for it, won. And this is on one where it did nothing right. If I did this trade, unless I spread something, unless I sold a soft delta against my purchase, there was no way to win. All right, does everyone understand that? So if I just bought the 225 calls, they were $7.10. They're now $5.70. You lost $1.40. If I did this spread, so I bought this for $7.10 and sold these calls at $75. I paid let's say $6.30 for that spread. Well, today it's worth about $5.60. So I lost less. Now what if I bought this spread instead? 150 versus 710. Now I paid $5.60. Hey, we finally got a winner here. Finally got something that didn't beat me. So if you didn't spread, you didn't win. You lost big. So now let's talk about maybe a bearish play. So I hate Elon Musk and Tesla. How would I set up a bear play? Again, I can do puts, put spreads, or we'll talk about this in a little bit, a risk reversal. All right, well, let's look again at all the different spreads I could set up. All right. I could do an at the money put versus an out of the money put. All right. Let's see how those guys performed. So I could pay $7.20. I could pay $3, or I could do the spread for $4.20. Let's see how we did on all these. Well, I got beat bad regardless. But if I bought that out of the money, I lost the worst. In this case, if I bought the hard delta, I did probably a little better than best. But I was risking, you know, if I bought the hard delta, I lost a ton. And at least if I bought the spread, I've got something that I can sell back. You know, there's some value still there. I mean, it's just amazing. So, the cheaper alternative, and I like these. This is the way I usually like these. All right, I want to set up a trade that is long inside of the straddle price, less than 14 bucks away, and short well outside of it. All right, and we'll look at, it takes advantage of silly wing skew that can develop. So what is silly wing skew? Well, sometimes people buy these way out of the money lottery tickets, and they almost never win, yet people love buying them. I don't understand it. All right, so silly traders buy up these little cheapy wings, and it might be the only piece of the trade that actually does get bid up, and they should be sold to the dumbest buyer. All right, so you can see how skewrific these can get. This is in Goog, and I wanted to show you, like, this is from a while back, Feb versus Jan. Here's another look at it. So let me show you kind of how that could have worked really well. So let's take a look at Apple. Apple from a few days ago. All right. So here's the day earnings comes out. Let's look at the day before. And here's this cheapy July 29 straddle. It was too cheap. Apple's 96.5. I could buy the 96.5 straddle for about $4. So I think Apple's going higher. What if instead of buying, and this is the cheaper alternative, folks, what if instead of buying this 97 call, what if I bought the 100 call for 60 and then sold the 98 call, or let's say I bought the 99 call for 95, and then I sold the 102 call at a quarter. I'd pay 70 cents for that 3-point vertical. That's a really good risk reward. Or I could pay 80 cents for the 4-point, 99 to 103. About 4 to 1. And let's see how that performs the next day. You can see, totally works in my favor. You know, if I bought the 97s, obviously I made $4. Great trade. I paid $2. It's now worth $6. I made $4. We like that. But look how well my 99-103 spread does. I paid 80 cents and instead of $2, and I still made $3.50. That's not so bad. In fact, that's great. By buying something inside of the expected move and selling something outside of the expected move, I can do really well. Now, finally, well, not finally, I'm going to have one or two more things to look at. What if I like a long term? So you're the opposite of me, all right? You think Elon Musk is a genius. You like the fact that, he's merging SolarCity and Tesla, because you know that when I walk in to buy my Tesla, I also want solar panels. Who wouldn't, right? So a risk reversal into earnings when vol is high can be a great way to use options to buy stock and get paid at the same time. So let's look at Tesla. This is September now. Volatility is still really high. So I want to own Tesla that's trading 225. Yeah. All right, well, what if I sold? So I want you to notice something. My 200 puts are $25 out of the money, correct? And my 210 puts are 15 bucks out of the money. How much are the 210 puts that are 15 bucks out of the money? They're $8.50. All right, now 15 bucks out of the money the other way is the 240 calls, correct? They're actually only 14 bucks out of the money. You know, the 210s are about 16 bucks really, and the 240s are about 14. My 240 calls are how much? 550. So what if I sold the 210 puts at 850 and I bought the 240 calls for 550? What kind of position does that set up? Let's take a look. Come on. Or here, we can use one that I already saw. All right, so we'll use Apple. So you love Apple. All right, let's go out to October. Well, Apple's trading 105.87. I can get $1.60 for the October 110 calls. Or the October 100 puts that are 6 bucks out of the money. All right, or I can do the 105s that are $2 out of the money. And let me get one that actually has, here, we'll use this guy. We'll use one that I can set up to be within reason. All right, SEP 23s. It's trading 106. I can get $1.60 for the 103 puts. Those are 3 bucks out of the money. Now, 3 bucks out of the money here, it's going to be about the 109 calls. Well, take a look here. This is the position I set up. So I'm getting paid. I participate if it rallies or sells off, right? And if it stays in a range, I just keep the credit. We see this a lot, and it can be a total layout. All right. So there's the risk reversal. I wanted to show you the one at Tesla. Sometimes after the bell, these can be a little slower to load up. 31 slider. So the point is these risk reversals can be really nice. Here's a Tesla one from Wednesday. You know, look at the huge credit I can get on it. It's a nice looking trade. Right now, the best simple trade for making money on earnings, all right, would be a butterfly. All right. So what I do is I set the long near the end of the expected move. I sell two way out of the way outside, and then I buy a cheapie. All right. And the nice thing about earnings flies is the upside juice gets so overbought I get to sell it to people. I sell as much as they want, and then I buy just a cheapie option to hedge. And they can pay out 10 to 1. I mean, so let's go back to Apple and look at that some of those cheapie butterflies. All right, here we are. Apple looking for a $5.90 move. All right, well, why don't I buy outside of that expected move? So we're looking for a $6 move or a $4 move. So I'll buy the 101 calls for 42 cents. Or the 100s for 60. Then I sell the 102s or 103s twice. So let's say I did 101, 103. 42 versus 16 twice, I'm paying 10 cents. All right, if I did 41 and 33, I'm paying really 8 or 9 cents for a 2-point fly. And then if I buy the 105s for 8, I'm now paying 15 cents to try and make $2. That's better than 10 to 1. Well, where does that trade go? You tell me. I paid 15 and now it's $2 versus 60 twice. So it's 80 cents plus 10 cents for my 105s. I make 90 cents on that. I bet about 15 to make 90. I do use broken wings. I didn't really trade Tesla yesterday, to be honest. I didn't trade Priceline either. I do some earning stuff, but those are two that I have such a personal hatred for Tesla that I can't trade it with a level head. And Priceline was just not one I played. And yes, I do use broken wings all the time. All right. Apple I played long. Straight up bought calls. Because the vol was too cheap. And we'll look at Alibaba here in a second. So like here's an old Facebook one. Look at the 10 to 1 payout on any of these flies that you set up. If you did the 100, so Facebook is trading 94. They're looking for about a $5 move. So if I buy the 100, 102, 104, or the 100, 103, 106, that's 70 plus 7. That's 77 minus 24 twice. So that'll be 30 cents. You can see it works out all right. Facebook moved crazy. And there were all sorts of cheap ones that you could do. All right, so now let's look at Alibaba. Alibaba has earnings next week. So let's take a look and see what's going on there. What kind of move are they pricing into Alibaba right now? Well, Alibaba's trading 84.75. The 85 calls are $1.85. The 84.5 calls are also $1.85. So the way we would look at this is $1.85 twice, which is $3.70, plus that 25 cents in between. So $3.95 is what the market is looking for. So if I'm looking for what amounts to a $4 move, I might want to buy the 87.5s or 88s and sell upside, or buy the 81s or 80s and sell downside. Is a broken wing fly similar to an iron fly? No. A broken wing fly has strikes that don't line up evenly. So let's take a look at Alibaba and look at what we might do. All right, my feeling is, as I look at this rally, and I look at the total lack of any volatility in Alibaba, that they're not looking for a big move. 39% is probably too cheap. So if I was setting up this trade, I would lean bullish. And if I want to be inside the trade, I would buy the 87.5s or the 88s. I'll buy the 87.5s here. Now we'll do the 88s. And then I would sell the 91s, $3. And then maybe buy the 94s. And obviously I'm not going to pay 12 cents, probably pay about 6 or 7. So when I look at that trade, they're pricing at about, my theoretical is 34 cents on a 3-point vertical, so about 10 to 1. And you can see how it could pay out. If things blow higher. That's a really nice payout, especially when volatility drops. So that is one, that's how I might set that up. Now final point. Volatility Princess. You see a lot of people that like to sell strangles, sell iron condors, and things like that around earnings. Yeah, I think if you're, I'll tell you, people say you only play one side. I'll tell you, most of the time I just skip earnings plays unless I really have a good feeling about how to play it. And I'll tell you why. And it kind of goes with this. Studies prove that buying premium and selling premium both lose. You know how much they both lose by? The bid-ask spread. So when you buy premium, you have to pay the ask a little bit. That tends to lose by about that spread. And when you sell premium, you also lose. It is completely ineffective to think you can sell premium over time around earnings and win. Or buy premium around earnings and win. You need to have a directional bias, at least for now. You know, I can show you some things that have a directional bias, things like broken wings, that I do, where maybe I will trade them around earnings. All right. But unless you do really well and smartly, which I'm not covering today, don't sell premium into earnings. It tends to be a bit of a waste of your time. I'd rather buy or sell premium when I don't have these type of events, when I have a much clearer view of what's in front of me. I'm more likely to win. All right, so in summary, sell the junk, buy inside the tent, inside the spread, use spreads, understand the straddle. Now, here's the deal I'm offering. OptionPit Live. All right, my chat room. I normally charge $125 a month. All right. Today it's just 17 bucks. And what do you get? You get access to our strategy letter that we update daily. And what's in the strategy letter? Trade ideas. All right. You get access to our chat room where me or Andrew and some of my people are in all day. We're going to teach you to extract dollars from the market in a risk-adjusted way. We're trying to get all the returns and less of the risk. You know what, Theo? Keep doing that, and eventually you'll blow out. I know people that did that in Google, and then it moved 150 bucks. Statistically, it is not a winner. So you may think it is, it's not. So you get to, I'm going to teach you how to buy premium. You learn how to sell premium. What we really do is we try to go for the return with less of the risk. Keep at it. All right. And Saturday the 27th, we're doing our next class, and that's on weekly option trading. If you have an active subscription to OptionPit Live, you get to attend the Saturday class for free. And for this month, we normally don't make it open to people on the $17 trial, but for this month, we are going to allow people to attend our weeklies class that are on the $17 trial as well, and that's going to be on August 27th. So get this. You get access to a chat room. You get our strategy letter. You get a Saturday class, all right, that we sell at 170 bucks or more on weekly options for 17 bucks. Go to optionpit.com/OP Live Special 17. Right there. All right. After the first month, instead of 125, it's just 97. So it continues to be a great deal. All right. Any questions? That's what I'm known for, is my reasonableness. What types of returns should you, well, it depends what you're trading and how you're trading and what kind of risk you're putting on. So every individual is different. So I would say that question depends on you. All right, any other questions? Can I share with you when I use broken wing butterflies? A lot, and that would be its own webinar on its own, Theo. But we will discuss broken wings with our weeklies class. And 1x3x2s. So this is a deal and a half, guys. You're getting like $300 worth of value for 17 bucks. I do have a special deal with LiveVol for my subscribers. Good question. You know, one of the things about LiveVol, here's how much we are integrated with LiveVol. We are the only educational organization that actually has our own scans within LiveVol's platform. I trade a lot of stuff. All right, folks. We'll have the recording out so if we don't have any other questions, I'll let you guys get back to your evening, and I want to thank everybody for coming. If you got questions, you can email me, mark@optionpit.com. You can call me 888-TRADE-01.